All right, let's talk about one of the most reliable trading patterns you'll find in crypto. I'm talking about the CME gap. And no, this isn't about hype or some kind of market sentiment. This is a structural quirk, a weird little feature in the market that's been, well, incredibly predictable for a long time.
Have you ever seen this happen? Bitcoin goes on a crazy run over the weekend, or maybe it dumps hard, and then, boom, Monday rolls around and the whole move just evaporates. It totally feels like a trap, right? But what if I told you there's a powerful, almost mechanical reason why that happens?
It's because over 90% of the time, yeah, you heard that right, 90%, the market is basically forced to reverse course and fill that price gap from the weekend. I mean, that's not just a coincidence, it's a huge statistical edge. And the real key here is figuring out why it happens.
So let's start with what we're calling the weekend price trap. Because, if you've been in crypto for any amount of time, you learn pretty fast that you can't always trust a big move on a Saturday.
Okay, so here's the pattern in a nutshell. Traditional markets are closed. They're sleeping for the weekend. But crypto, it just keeps on trading. Prices can move like crazy. And that creates this void, this gap, between where the big institutional players closed on Friday and where the price is on Monday. And what happens next is that the market feels this structural pull to go all the way back and fill that gap.
Okay, so to really get why this happens, you have to understand this fundamental conflict that's right at the heart of the market. It's basically a clash of two completely different worlds.
So, on one hand, you've got the crypto market, which is on 24/7, it never sleeps. And on the other, you've got the traditional 9-to-5 institutional world. The big one here is the Chicago Mercantile Exchange, the CME. They shut down their Bitcoin futures market every single weekend. And that creates this kind of blackout zone where the big money is offline, but Bitcoin? Oh, it keeps right on trading.
And that right there, that's what a CME gap is. It's really just that empty space you see on the price chart. It's the difference between the CME's closing price on Friday afternoon and where it opens back up on Sunday night. If the actual Bitcoin price moved a bunch during that blackout period, well, a gap is born. Okay, so we know a gap can exist, but why does it have to get filled? What's the force pulling it back? Well, the answer is a word you hear a lot, arbitrage. And in this case, it's a really powerful, almost mechanical process that just forces the market to fix itself. Now, this is going to sound crazy, but the CME futures market, it only accounts for something like 5% of the total global volume. And yet, it dictates the price for everyone. It's the absolute classic tail wagging the dog scenario. And the reason is that the amount of capital and leverage sloshing around in these derivatives markets is just massive. We're talking 4 or 5 times bigger than the regular spot market. So when the CME moves, it literally forces the global spot price to follow it. So this whole process really boils down to a pretty simple 3-step cycle. First, you have the hedge. This is where big institutions do what's called a basis trade. They buy actual Bitcoin and they sell CME futures at the same time, and that lets them capture a tiny, almost risk-free profit. But then comes the disruption. That's our weekend gap. It totally throws their perfect hedge out of whack. And that forces them into step 3, the fix. They have to rebalance their books.
And here you can see the whole engine in motion. The key word, and I really mean this, is forced. They aren't choosing to do this. They have to fix their broken hedge. And to do that, they have no choice but to buy or sell a ton of actual Bitcoin to get their positions back in line with the CME futures price. And it's that massive forced wave of buying or selling that literally drags the price right back down or up to close the gap.
Now here's another piece of the puzzle. Think about all the Bitcoin that's just sitting there, held long-term in things like the new ETFs or on company balance sheets. That Bitcoin isn't for sale. It's not being traded. So what that means is the actual market liquidity, the amount available to trade, is way thinner than you'd think. So when these big institutions are forced to make these rebalancing trades, their actions have this huge, oversized impact. It basically turns the gap fill into a self-fulfilling prophecy.
All right, so we've spent a lot of time on the why this happens. Now, let's get into the how. How do traders actually try to play this pattern? And maybe even more importantly, what are the risks involved? Because there are definitely risks. The basic strategy is actually pretty simple. You fade the move. So if the market pumps hard over the weekend, opening way above where it closed on Friday, that creates a gap below the current price. The trade is to short it, betting the price is going to fall back down to fill that gap. And if the market dumps, same thing, but opposite. It creates a gap above. So the trade is to go long, betting it'll rise. You can almost think of Friday's closing price as a magnet. But, and this is a big but, patience is absolutely critical here. This is not a get-rich-quick instant trade, not at all. The average time it takes for a gap to fill is about 2 weeks. And that statistical edge? It holds strong for up to a month. So you have to be mentally prepared to hold a position for days, maybe even weeks. Okay, and listen up, because this is a rule you absolutely cannot forget. A gap is not filled just because the price on Coinbase or Binance touches that zone. Nope. The only chart that matters is the official CME futures chart. On TradingView, the ticker is BTC1. That chart's price has to physically enter the gap zone. Until that happens, the trade is not complete, period.
All right, let's get serious about risk for a second. Using high leverage on this kind of trade is what a lot of people call a widowmaker. And for good reason. The price can, and very often does, move wildly against you before it finally turns around to fill the gap. If you're using too much leverage, you're going to get liquidated long before your prediction comes true. Your money will run out before the market proves you right.
So if we were to boil it down to a simple checklist, it would look like this. Number 1, always use the right ticker, BTC1 on the CME chart. Number 2, identify the gap, that empty space from the weekend. Number 3, figure out your direction. You're always fading the move. And number 4, and this is the most important, manage your risk and be patient. That means low leverage and being prepared to wait it out.
You know, for years, this has been one of the most reliable, almost guaranteed trades in all of crypto. But as they say, all good things must come to an end. This little inefficiency in the market, it's about to get patched for good.
It's official. The CME Group has announced they're planning to launch 24/7 trading for their Bitcoin futures. It'll probably start sometime in early 2026. And the logic here is super simple. If the market never closes, there's no weekend blackout. And if there's no blackout, there can't be any gaps. So yeah, this entire strategy has a very firm expiration.
So there you have it. As the crypto market grows up and matures, one of its most famous and predictable little quirks is literally being engineered out of existence. It really leaves us with a fascinating question, though, doesn't it? As this door closes, what's going to be the next big structural edge that people discover?